Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Wednesday, September 7th. It's about 8:17. The market's going to open up in about an hour and 13 minutes. To be specific with you, before I begin, I want to thank you for all the comments, the feedback that you've been posting below this video. I've been getting questions like, Roger, you get 1,000 views a day. How come there's not a lot of comments? People don't like to post comments. I don't know. Post comments below this video. I'll respond. And if you want me to cover something, let me know in the comments section. I'll respond. If you have a question, put it in the comments section. I'll respond. And if you want to send me an email, have any questions, I'll gladly answer them. support@marketgeeks.com. So let's get into today's session. Dow's down about 65 points. Nasdaq's down 33. And the S&P, as usual, is meeting us in between. I'm expecting the market to begin thinking of a turnaround. We've been having, I think, the biggest consistent downward spiral since 2016. Kind of a big one. And I think some of the sectors are getting a little bit overdone. As far as Fed data, we have the ISM Service Index, not a major report. Tomorrow, actually, wait a minute. What am I saying? Today's Wednesday. I'm one day back. Wait a minute. Today's International Trades in Goods and Services. That comes out in about 11 minutes, and that'll reflect on global economy, supply chains, and how the supply chains are impacting the U.S. exports and imports. Very important report, probably one of the most important reports this week, aside from the Fed doing a lot of talking. We got Mr. I don't know what I'm going to say till I get reappointed Powell tomorrow. And then you've got wholesale inventories. But honestly, jobless claims and international trades in goods and services are the only big ones. Also, we should expect to see a little more volatility and a little more trading action today versus yesterday, because yesterday was the first day post-holiday. Anytime you have a 3-day weekend, especially Labor Day, it's one of the biggest. It's the one we kissed summer goodbye to. You are going to have some low-level volatility, liquidity, and I wouldn't be surprised if we will get to see the entire market structure by tomorrow. Today's still a little too soon. So again, international trades in goods and services, it's coming out in just a few minutes, and I'll come back to this report in a bit, but this is what they're expecting. The consensus is negative 70. Looks like we're right near the top end. It'll be very interesting to see. I'm hoping that the number is lower than possible. It'd be great to see this number at 69, 68. It would tell us that the deficit is getting smaller, which would be better. Again, $79.6 billion in deficit in June. That's just painful. So we'll get a better understanding of where we stand in just a little bit. Now let's talk a little bit about global economy. And remember, don't go anywhere. Today's Wednesday. I give you red meat. I give you a long trade, and I give you a short trade. So let's talk a little bit about global economy. And in this case, it's mostly about global economy. Sometimes it's all about U.S. and sometimes it's about China. In this case, it's definitely about China. Pay attention. This is important. And we'll circle back to this when we discuss one of our weakest stocks. Because remember, today's Actionable Wednesday. Global shares were mostly lower Wednesday as pessimism prevailed about higher rates ahead of Wall Street continued a late summer slump. I don't know about summer. I think we're past summer now. Shares fell in Tokyo, Sydney, South Korea, and Hong Kong, but little changed in Shanghai. Oil prices fell while Japanese yen continued to decline against the U.S. dollar. In Japan, government listen to how desperate they're getting. They're giving away about $350 to needy families to help cope with daily needs and energy prices in a move also designed to boost the lagging economy. You know what? I'm going to tell you guys some tips. Start raising interest rates if you want to stimulate the economy. Keeping interest rates low is not going to stimulate the economy. Giving people more money is not going to stimulate the economy. Raising interest rates is going to stimulate the economy. China's trade weakened in August. That doesn't help U.S. As higher energy prices, inflation, antivirus measures, we're still talking about antivirus measures. It's been like, almost 2.5 years, weighted on global and Chinese consumer demand. Imports of Russian oil and gas surged. Chinese customs data shows that exports rose 7% over a year ago. That's good. A deceleration from July's 18% expansion. That's not so good. While imports contracted by 0.2% compared with previous month. Not really, I don't care about imports. I care about exports. Now, demand for Chinese exports has softened as Western economy cools and the U.S. Federal Reserve and central banks in Europe and Asia raise rates again to contain surging inflation. It's the same song and dance. Repeated closures of Chinese cities to fight virus outbreaks has weighted on China's consumer willingness to spend. And the Federal Reserve has indicated that it will not let up anytime soon on raising rates, which is exactly what we expected. Energy, crude is about $86 a barrel, far cry from the $100 a barrel that we saw recently. Now, in terms of what's going on today, I want to show you something interesting. Do you remember when the market was about 2-3 weeks ago and we were still in this upward climate right here? And I was showing you how many stocks were making 20-day highs, and it was like 400 something, and then 400 something was. Let me take you back. Let me go back 1 month. Let's see if I could do this. September. No, let me go back 1 month. Actually, go back 3 weeks. 21 days. Yeah, look at that. 210.38. Let me see if I can go back another 30 days. I remember it was like 400. Nope. Where was it? We're still up here. Not that's too far back. 15 days. Let's go back. There we go. Look, right at the end, right at the peak here. Right at the end. Look at that. 346. Look at this. Let's go back 14 days. 14 days. 365 to 38. This is right here, right at the peak. Now, that's 365 stocks making 20-day breakouts and 38 stocks making 20-day breakdowns. And at one point in here, it was like 450, 20. I remember. It was pretty bad. Now, look at today. You got 495 stocks making 20-day breakdowns and 22 stocks making 20-day breakouts. That's the opposite. This is getting a little too extreme. A lot of these stocks are just way, way overdone. And it looks like the market is getting ready to bounce back. Also, if you look at the S&P 500, if you look at it over actually, let's look at the NASDAQ. If you look at the NASDAQ, which is way overdone, you've only got 18% of stocks trading above the 200-day moving average, which is not all that much. So when you look at it, when you look at it like that, let's see here. I just keep doing the same thing over and over and expecting different results. Let's see here. Does that remind you of anyone? All right, look, we're getting towards the bottom. So unless we're really going to drop, I think the market is going to start heading higher from this point on. And if you look at some sectors, you will see that most of these sectors are in fact looking a lot like this. So again, you've got 495 stocks making 20-day breakdowns and 22 stocks making 20-day breakouts. That's a sentiment that really, really needs to change. That's too much, way, way too much. Now, in addition to that, as I showed you, you got some sectors here. Look at communication services, 12%, 12%. Real estate, 19%, 13%. Financial, 15%. Consumer staples, 18% of stocks are now above the 50-day moving average, only 36%. So this is, in fact, a lot like I said it would be, a lot like this. Actually, it looks almost identical to this. That means we're getting too much too fast. And if you look at overall momentum levels on the overall stock market, you will see that price is, in fact, getting a little bit towards the bottom. I mean, it can go a little more, but if you look over the last 20 years, you will see that unless there's a major bleed, we tend to stop around these levels. So this is not a time to start really thinking about aggressive short positions. This is a time to hold on because I believe the long side is going to be coming. Also, volatility. As we've been going down, volatility has not really increased at all. I mean, it went from 19 to 27 during this period, barely broke through, not looking that good. Now, let's look at the bond market. I want to show you guys something. This is the bond market, and as I mentioned to you, I said it was going to break down, and then I thought it was going to come up. I think the bond market is going to start coming up right now since momentum levels on the bond, if you look at RSI, and let me make it a little cleaner for you. That doesn't clean it up that much. Here, let's remove some studies. Let's remove some studies. Here we go. See, divergence. Let me pull this. We're going lower here, and we're going higher here. Higher, lower. Too much too fast. Probably will come up maybe halfway in, cause a rally in the stock market, and then will maybe come down some more. But the bottom line is right now, you've got to watch the bond market. And as soon as the bond market starts heading higher, or at least stops going lower, the stock market will revert with it. Let me show you. This is our Cathie Woods stocks, just to show you how correlated they are. So this is ARK, right? And this is the bond market. Very, 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 very correlated. Very correlated, as you could see here. So I'm anticipating a little bit upside. I think we're a little bit overdone, as you could see here, by the number of stocks making 20-day breakdowns versus 20-day upsides. It's just way, way, way too much right here. 22 versus 490. Look at that. 22 versus 495. That's a bounce waiting to happen. Keep your eye on the bond market. Keep your eye on communication services, and I'll tell you why. Communication services is breaking down along with bonds, and I think it's had it, and it's overdone right now, and it's also diverging, and I think it's going to follow bonds a little bit higher, but I think we are overdone on the communication services, and as well as most stocks. Now, to the upside. First thing, before we look to the upside, the first thing we want to do is we want to see which sectors are leading and which ones are lagging. And to do that, we go to our 11 major sectors. And when we do that, we will see utilities, energy, consumer staples, right? The fun stuff is right here on the bottom. And on a monthly basis, it's been cleaning up too. Energy, utilities, financial, consumer staples is here. But look at this. Consumer discretionary, communication services, and technology. On a monthly basis, they're all in third spots. So going long, we want to do, what kind of stock is this? This is an industrial stock. Republic Services. I like this stock right now. I like it quite a bit. It only went down to here. I think it's going to break above higher and start going higher. And as I showed you, industrial stocks are coming up. On a month basis, they're the fourth strongest stocks right now. They're gaining some strength. So I like this Republic Services. I'd be buying at these levels, and it breaks below this pivot. You may want to get out. To the short side, things aren't looking good in China. China money is huge for Wynn Hotels gambling. They even report how many Chinese people and how things are in China because it's such a big impact. If you look at the trend, it's going lower, and I think it's going to continue moving lower. I don't think anything's going to save this stock. So I am short Wynn. I would want to be short Wynn, and I would want to go long RSG right now. Those are the two stocks that I'm liking. Now, let's see if the report came out. We've been waiting for this report to come out. Let's see if it's out. And keep your eye on the bond market. The bond market's going to give us all the clues we need, the communication services, and there's a question of whether this consumer stocks are going to bounce or come back into their range right here. And I think they're going to actually bounce. Let's see. Actual? Oh, not that bad. We were expecting 70.5 billion. We got 70.6. Nothing crazy. Let's see how the market's not reacting too much. All right, before I let you go, I've got something important for you. Folks, it's no secret that most traders are having a hard time in this market. After a nice rally in July, the markets have moved straight down the past 2 weeks. No fun for anybody. And that's why I want to show you 5 chart patterns that have worked really, really well so far for our traders and investors, for our members. So far in 2022, the patterns have helped me achieve a 100% win rate with an average return of 18.5% per trade. Nothing to sneeze at. The holding period has been about 3 days. Not bad, right? Now, of course, on average. The strategy will eventually close the loser. It's just how it works. All trading carries risk, and no strategy can deliver a 100% win rate forever. It's just not how it works. That being said, I'm really, really impressed at how well it's been doing. You can get all the details of the 5 chart patterns right now by clicking the link below. Do it now. And watching my trading session. It covers why trading strategies that worked for the last couple of years ain't working right now. How traders are using candlesticks totally wrong. You will love this part. And it's all back tested, no monkey business, no opinions, all data. A little known secret of how to tap into dirt cheap options? That's right. How candlestick patterns can be used to identify short-term price reversals before an explosive move takes place. You do not want to miss out. And catch RSG to the long side, win to the short side, follow the link below, Comments, feedback. I want to hear from you. If you have any questions, post them. I'll answer them. Bye, guys. Have a great, 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 great hump day.